You're listening to the Multifamily Journey Podcast. In this show, you'll hear industry experts share tips of success and failure from their real estate investing journeys. You'll get a transparent look behind the curtain while you learn to fulfill the lifestyle you want to live and achieve your wealth goals. Get ready for the journey to financial freedom through investing in multifamily real estate. Here's your host, Blake Dailey.
All right, we're kicking it off today with a great episode and a super solid investor and friend of mine who has made it to around 30 units now. Andrew's a good friend of mine and someone who has given me a lot of good advice, and what he provided today on the show is going to be of good value to someone looking to get their start in multifamily and also getting an idea of ways that they can get started. I'm super excited to get this show going today. I wanted to create an interview style podcast that's very transparent, provides actionable advice. I think some podcasts that I've listened to have become frustrating because they get a little pitchy, sending out products and, this and that, and kind of lose their touch with investing. And with me, I'm actively investing. I have 11 units of my own and now expanding into large commercial multifamily with an awesome team of like-minded people. So my focus is actually investing and passing along the tips I learned and the experiences from my journey, and also the mistakes, because I feel like that's where the best learning lessons come from. I want to share all that to help you. So I really love helping others realize the power of real estate and that the financial impact it can have on your life and everything. So it's helped me replace my living expenses with cash flow. And if I can help just one other person achieve financial freedom with this podcast, then the time is worth it for me. And sure, part of the reason I wanted to start a podcast was because I want to interview more successful investors to get tips from them, but those tips get passed to the listener. So it's a benefit for everyone, and love that. So I think this is a great format to help others, but also learn myself. So I've also created the ability for listeners to add to the show. If you go to the podcast at the podcast page, edit that. So if you go to the podcast page at multifamilyjourney.com, at multifamilyjourney.com/podcast, you can enter questions that you want to hear answered from the successful real estate investors that I interview. I thought that would be a good way to get engagement and a good way for others to contribute to the conversation. So check that out, enter your questions, and if you want them answered, yes, I'll actually read them and give you a shout out when it's answered. But other than that, I'm really excited, like I said, to get this going and provide value to you all. I hope you like it. And if you do, please go to iTunes and leave a 5-star rating and written review, even if it's just a short sentence, because those ratings and reviews do a ton to get the podcast ranked. So just want to get it out there and get it in the hands of more people who can help them on their journey and, maybe help them avoid some of the mistakes that I've made and learn along the way. So with that, let's get to the show. All right, everybody. Hope everybody's having a good day. We got Andrew Dorazio on here. I'm excited to get kicked off with this podcast. So Andrew is a former officer in the United States Army. He now lives in Chicago, where he's a realtor. Him and his family are there. So he's doing deals in the Chicago market. He's also a supply chain consultant right now with one of the big 4 accounting firms. And on top of all this, he's also investing in real estate, doing some awesome stuff. He's an Airbnb investor. He's got some properties in Nashville and also Jacksonville right now, doing a Burr and B, which is a strategy I love and we'll probably talk about a little bit. Sure. And then there's also a small multifamily investor with 1 of 4 units right now, and then trying to take that to the next level and get into commercial multifamily. So this will be a good discussion, how to get from all of that up to the next level. So Andrew's got a lot of experience with doing deals and partnerships and all the kind of different ways to make deals happen. So we will get into that. But Andrew, welcome. Thank you for being on here.
Thanks, Blake. Thanks for having me. Really excited to be here today.
Awesome, man. So why don't we start out with, I know I just gave a little bit of background, but let people know a little bit more about you and how you got started with your real estate journey.
Yeah, absolutely. Thanks. If you hear my daughter in the background, just ignore her. We're living through these COVID days here, right? So, awesome. So very happy to be here. Thanks for thinking of me. And for the viewers that don't know, Blake and I, we have opposing military backgrounds, but that's okay. We're in a mastermind together, and we spend a lot of time doing accountability to help ourselves grow together as real estate investors. It's been a pleasure working with him there and growing alongside each other. So a little bit of background on me. I I've been investing in real estate since 2007, 8-ish or so, which of course, really great time to start as a real estate investor. I was stationed in Fort Bliss, Texas, and El Paso for the first 6 years of my military career, and I got in the real estate bug a little bit before that during my time at the academy, and I'd watched my father buy some properties over the years, and I thought that the idea of that mailbox money was kind of a cool concept, and just own some property and pick up rent. And certainly real estate in New York is a little bit different than real estate, where I'd grown up in versus El Paso, where I was stationed at. So jumped right into the investing world and first of all, a condo to live in, which, looking back, I'm mostly critical about that purchase out of any of the things that I've purchased. I still own that to this day, but I purchased a condo to live in with a roommate. So it was kind of like a house hack, I guess, to start before a house hack was a thing. And then I immediately bought a 4-unit property on the east side of El Paso, which I still own today as well. So, and then the market kind of crashed in 08, 09. And although El Paso wasn't really, it was kind of insulated because First Armored had moved, 30,000 troops or so to the base, plus families and supporting businesses and all that. So El Paso was going through kind of a growth period, but demand was being matched by supply as like the building kind of expanded east. I didn't really do much for the next couple of years, real estate wise. I bought a laundromat with some people, and then that didn't really work out too well. It's another story for another day. But I kind of sat tight for a while as the market started to cave in on themselves over the next couple of years. But my real estate investments kind of held strong. So from there, fast forward like 5 or 6 years now, I kind of just started to save capital and wait for an opportunity to present itself to me. And I went back to the El Paso well once I already moved to Chicago. So 2014 and 15, we started looking at larger multifamily projects. And I found an 11-unit that I really liked there in El Paso. So I partnered with a few people, a few of my classmates to purchase this 11-unit multifamily and like central / east, northeast El Paso, which we still own today as well. From there, I started just to build little micro partnerships with folks and picked up another 14 or so units in the Cleveland suburbs with a group of ex-Army folks that I knew from my time in, and then got into Nashville. I have a couple Airbnbs there, and now got a few other partnerships in Chicago and in Jacksonville as well. So my time in real estate has evolved over the last 10 years or so, and certainly dabbled in a lot of different things. And I've kind of figured out what works and what doesn't. But as you know, it's a constant learning curve every day as things change, as the economy around you shifts, and certainly growing as it grows as well.
Yeah, for sure. That's a really good point. Just from, this time last year, it's the real estate market's a lot different. Right now we're kind of in the middle of COVID going on, and it's definitely different. But wanted to unpack the journey a little bit there. So you said you started in El Paso in a market with a military base, and that was kind of what was driving the return there. And I'm kind of in a similar market here in Panama City, Florida, with the base here.
Yep.
So that's very interesting. You said you bought the single family to start with, and then went right to a 4-unit after that. Can you kind of explain what led you to go, get the 4-unit after, living in the condo? That's a different
Yeah. They were actually a month apart from each other. And it's funny to look at the lending standards of early 08, or late 2007 comparative to where we're at now. I was able to buy the 4-unit with an LLC. I did it from a small bank there. I didn't really know what I was doing. I'd read some books, but Bigger Pockets wasn't really around. There wasn't as many like online resources. I remember, I was telling you this once before, but I remember sitting at training in Georgia, and I was literally reading like a Foreclosures for Dummies book in 2007, and just trying to understand how to buy real estate. So I bought the condo. I used the conventional loan. I think like the interest rate was like 6% at that time. Again, I was still learning, and that was just, I was renting prior to that. I figured I wanted a place to live. I didn't want to make my landlord rich anymore. And I had a roommate that lived with me. So I said, okay, he'll pay for pretty much most of my mortgage payment. The first property I bought was $92,000. So think about that from a monetary perspective and how cheap El Paso was. So good market to start off in for a first time home buyer. Again, huge learning curves, but I was very ambitious and I wanted to grow, and I knew real estate was a great avenue for wealth. And it was one of those first things where like my dad actually got excited about it, talking to him, because he knew I knew I was making a good decision when I saw that he was getting excited about it. So the 4-unit, though, I started looking for other avenues and other ways to get into real estate. And so I linked up with a realtor, and I started looking at some multifamily properties. To put this one in perspective, this ended up being probably one of the better, or one of the best investing opportunities I ever made. It's 4-unit. I paid $190,000 for it. Over the last decade, I think I've increased my rents by at least 50 to 60%. I've been able to refinance it 2 separate occasions to buy more property, and I still own it to this day, and it still cash flows me over $500-600 a month. So I used a conventional loan on this one as well. I put a little bit too much money down. I'd saved up some money from a few different areas. I had a little landscaping business when I was in high school that had done pretty well. So I had saved up some money from there. And of course, went to college for free, so that helped a little bit. So I was able to not have any debt coming out of school, and I was able to squirrel away some money real quick and put that as a down payment. And then, the market crashed. So I actually tried to refinance a couple times in 2011 and 12, and bank after bank were shooting me down, and because I wanted to pull some of that cash out and buy more property. We were always exploring back then with funny ways how we can leverage other people's money. And again, the resources weren't always there. And between deployments and my job, I really didn't focus on growing too much at the time until 2015 or so hit.
Yeah, that's an interesting point. Because of the lending standards, it forced you to have some creativity with your own investing, and then pushed you to other avenues. You're talking like you mentioned, like the 11-unit with your classmates from the academy, going and doing that partnership rather than going some different ways. So when you got back into it heavily, and you said 2015, is that when you started doing the partnerships for all your deals? And if so, what caused you to do that? If it was more than just the lending.
Well, even to this day, scaling is always a difficult challenge when it comes to real estate, right? It's, I don't want to say it's impossible, but without an unlimited sum of down payment money and bank space, buying duplexes, tries, quads over and over and over again is difficult, unless, like I said, you just got a limited pool of down payment money, or you do some value add work like a bird deal, right? So those are really the only ways to scale. And again, that stuff wasn't as popular or prevalent, or was getting more popular in 2000. I said, okay, well, one way I can grow if I didn't have all the money myself was partner with other folks. So a couple of my buddies had already invested in some real estate in the past, and we were talking and chatting about it. So we took a trip back down to El Paso. I brought my wife with me, and we went to go look at some properties, and some were absolute dumps, and some were pretty good. And we ended up with I'd say a C+ class 11 unit that we wanted to go with. And some really big lessons learned on this one. My first larger apartment complex, I would say larger, obviously small comparative to some of the big ones out there. But we did a lot of our due diligence. We made a few mistakes early on. They conveniently didn't have the keys to all 11 units. And of course, the 10th and 11 units that we didn't get into had a lot of problems. So, and they were noted on the inspection report, but we didn't physically see it. So we didn't understand the extent of the issues. So it was more than just damage and hoarder type stuff. It was these two people had weird arrangements with the owner. One was the maintenance guy that was not paying rent, and although there was a lease on file, so there was some fraudulent type stuff that went down, and that we didn't learn until afterwards. And then we also, these are very low rent apartments, $500-600 a month, and so we weren't sure what our recourse was going to be for trying to go after them. So we just evicted these people that didn't have real leases in place or were living with dangerous stuff in their units.
What a good way to break into commercial multifamily, right? It's a good lesson on due diligence. That's why oftentimes I hear go into every unit, or if you don't, if there's too many units, have contractor go in some, or your partners, make sure you see all of them. So that's every
single unit. Yeah. So we learned that lesson the hard way. We had to over the course of the next 6 months, we ended up evicting 6 of 11 of the tenants. Some we did cash for keys. Some just left on their own once they got evicted, and then it all started to make sense why this guy wanted to sell it. He ended up selling it for $100,000 less than what he was originally asking for, which should have raised some red flags at first, but
at that point,
but didn't. So anyway, once we ended up firing our property manager as well. I had a really good property manager down there that handled my fourplex and my condo, and they did a good job with those, but they weren't really well equipped for handling some of the lower income, larger apartments. And so my partners and I started interviewing other folks, and we ended up finding probably the best property manager that I've ever worked with in my entire career. So it worked out really well. And he just came in, cleaned house, and within a year of owning the place, we had lost a bunch of money in that process. We had to put a new roof on as well. But within a year, he had got the property stabilized, and we've been making money ever since. So
that's awesome. That's another good point, is finding the right members of your team, right? Because the wrong property management can ruin your multifamily asset and your returns and all that, which you found out. And then once you got the right person in place, everything started rolling and
made all the difference. And then I shifted all of my other properties over to him, and now anybody that's looking down there, I plug this guy, because I tell him on a regular basis, I wish I could multiply you and put you in different cities, because he's the perfect combination of tough but fair, and but also has systems in place to keep all the accounting and the communication in the right order. So very happy with this guy. And we've had disastrous issues in some of our other cities. So certainly I know firsthand property management, to make or break you as a new real estate investor.
Yeah. When you find the right person, you definitely want to hold on to them. And anybody looking into multifamily too, that's definitely a position you want to take very seriously. Like we were just talking about, the right property manager can kind of ruin your investment or make it return really well. So interview multiple property managers, get on the phone with them, have your list of questions ready, and see how each one does with that. Meet them in person. Take that one with some due diligence and really working to find the right one for sure.
That's a really good point. I actually have a good due diligence document that covers property management questions. There's a lot of things that, and there's a lot of good Bigger Pockets articles on this as well. But it's certainly important to go in with the right question. And if you're a newbie investor, it's kind of you might shy away from asking some of these. Some of them come with experience over time, but I always try to ask questions like how are property managers being paid, right? So sometimes it's not just, oh, I get my 10% of rent roll every month. It's some of these property managers are I don't want to say in cahoots, but are tied in with contractors, and so there's always a markup fee for all of your any work that gets done, and they also charge to go out to like oversee work being done, and what's that hourly rate look like, and so you want to find out what's included in that.
And lease-up fees is another one too, to where they get incentivized to have high turnover and high vacancy. So that's another one to look out for as well.
100%. That one will kill you. So a lot of them charge a full month's rent. So now you think about it, it's like let's say you get a year lease in there, and then let's say there's a couple weeks of turnover time. That's another big thing I always ask about. What are your turnover procedures? Because I know my property manager down there is like a couple of days where it used to take my old property managers who were a little bit bigger and like didn't focus on the little clients that much. It used to take them like 3 or 4 weeks sometimes, and all that's money, So it's like, how do you incentivize these folks to like make sure you have your best interest in line? The other thing somebody taught me once too was sometimes property managers have it backwards by charging a percentage fee instead of a flat fee, right? Because and I mean this is kind of counterintuitive for a property manager to tell me this, but he was saying, a $2,000 a month unit requires less work than a $500 a month unit, right? So if you think about that, if they charge 10% of rent roll, they'd be getting $200 for the $2,000 a month unit versus $50 for the $500 a month unit. And typically the cheaper ones are more work because they're just laid on
worse tenants, different kind of
worse area, worse property, So I had a property manager once that charged a flat fee, which made sense, different than my guy in Texas, but something to think about too. So understanding how a property manager is incentivized is super important.
Good point. So these early deals and still the ones you're working on have been joint ventures so far. So can you explain quickly kind of what a joint venture is and how that's
absolutely. There's a couple ways to structure a partnership, and just a caveat, I'm not a lawyer by any stretch of the imagination, and this kind of goes back to like assembling the right team. So I have partners in the El Paso 11 unit, in my Nashville properties, and my Chicago, Ohio. Pretty much all of my work now is with partnerships. I like working with other people, despite some of the things we talked about earlier, Blake. That partnerships can cause trouble. You want to make sure you're going into a partnership with the right people.
Yeah, just like finding the right property manager, right? You want to find the people who fill kind of in partnerships, fill your gaps or what you're weak at, right? So Correct. If you're really good at underwriting, maybe you want to find the person that's really good at, managing contractors, stuff like that. So finding, what.
Yeah, absolutely. You always need a strategy guy or gal and a detail oriented guy or gal. Yep. It's super important, and you want to make sure that A, you complement each other, and B, you get along with each other, and you're not going to fight over petty stuff. And you want to make sure people are aligned on certain kind of key things. So I think that's before you even get into buying a property, you want to start with understanding who you're getting into business with, and even if somebody's your best friend, you might not know how they operate with money or business, and so it's important to get aligned on A, what are your values, what's important to you, and B, kind of what's the overall vision of this, right? Do you want to grow? Do you want to just buy one property? I think knowing where even if you don't have to dig too far into that future state, but thinking through it at a high level, okay, like, am I one and done with this partnership, or is this something that's going to grow organically over time, right? So understanding that up front. You don't have to know all the details, but just thinking through and make sure you're aligned with your partner. So I know I just went off on a tangent there. Let me back up a little bit. So, there's a lot of different ways you can get into real estate, and certainly partnerships are a great way. I formed LLCs for all my partnerships, not entirely necessary. In fact, you'll see a lot of people that talk about different ways to get into real estate without an LLC. It's just a way to limit your liability, right? So if somebody sues you for, let's say, falling on the front steps of that property, the limits of their ability to sue you for more than the value of that property are capped, right? So, we talk about umbrella insurance, other policies like that protect you.
And basically what he's saying there too is that because you have the property in an LLC, if anybody comes after you, they can only come after what's in the LLC. So the LLC separates like your personal assets, your house, your car, whatever, from that business. So
Correct.
If any litigation happens, it's on that LLC. And that's why a lot of times you'll hear people too, like put each asset in an LLC. And when you're talking with commercial multifamily, that's what you do. But sometimes you can package houses together because each LLC has costs, but just a way to separate yourself from the asset in the business.
For the entity. Yeah, absolutely. The other thing, it's an organization thing too, right? Like I like to keep separate bank accounts for each of the partnerships I'm in, and it helps kind of delineate where your costs and income is coming from, and it makes accounting. I do most of the books for my properties, so it makes my life a little bit easier. You can establish and there's certainly other ways to do this, right? So this is just the way that's worked for me. It helps kind of create a clean boundary between your own personal finances and the entity that owns that asset. So yeah, back to so create an LLC. We brought the team together. We started to assemble our outside team, but again, as part of that partnership, the LLC or that group, that entity, we create what we call an operating agreement, right? So it's a big piece of the paperwork associated with building a partnership. And basically what that operating agreement aligns on is a lot of legal jargon that talks about, okay, what could happen under certain circumstances, a death of a partner, somebody that wants to dissolve their ownership, somebody wants to come into the partnership. It's all spelled out. And a lot of that state to state specific language in there. Not always necessary to have a lawyer review, but certainly if you're going to bring in outside parties, you want to have that operating agreement vetted by an attorney or somebody smarter than you.
What it does also is, establishes roles and responsibilities so that if an issue arises, you can always revert back to the operating agreement and say, when you have a disagreement between partners, no, we're doing this in this situation. Well, the operating agreement says this, so this is what we're going to do. So it just creates accountability for everybody, right? You can't go back on it and like, here it is. So really, I always have an appendix. Yeah, I always have an appendix added to each one of my operating agreements that spells out who's doing what, right? What are your roles and responsibilities? That may evolve over time, so it's sometimes good to go back and revisit those and make sure that they're up to date. But certainly a way to guide the business and who's going to be doing what, accountability and responsibility. Yep. And that's kind of how all my joint venture agreements have been. And on the most recent one we did, it was just me and my partner on a duplex, but we outlined all the roles and responsibilities. I'm doing this, he's doing that. So it's clear, right? We had the discussion up front so that for anything that happens later down the road, Hey, we've talked about it and here it is written down. So really helps kind of a cover your tail kind of stuff. Absolutely. Yeah. And, it's partnerships can go sideways pretty quickly, and you want to make sure that everyone's comfortable with all the paperwork. And, and there, again, there's right and wrong ways to do this. The other thing people kind of mess up sometimes, when you think about bringing other people into a real estate deal, and this kind of goes into a little bit beyond partnerships, but if let's say you're bringing in other investors in to use other people's money to buy a deal, right? Depending on how the loan structures, most banks, unless it's commercial, most banks aren't going to allow you to put an asset under an LLC these days, depending on the loan type and the bank, and a lot of new rules that came out since 2009 and Dodd-Frank and all that. So the asset itself
is deeded to whoever's on the note, right? So if you as a person are guaranteeing that note, typically that property is going to be deeded to you as the individual note carrier, right? Or as, whoever your GPs are in the deal. Obviously depends on how this is all structured and set up. But the other thing to note too is that if it isn't in the LLC's name, and you bring other investors in, they basically don't have any ownership in anything. They have ownership.
They don't have any recourse should something happen.
Right.
Yeah.
So you want to typically the way to do this is to quit claim deed that property into the LLC's name. Fairly straightforward process. It's just a paperwork trail. Certainly talk to a lawyer first before anybody does anything like that, but it's an easy way to get the deed switched back from your name into the LLC's name to give people I now have interest in this LLC, which, oh, by the way, owns this piece of real estate. Yeah,
that's a good point. You definitely in your operating agreement and the paperwork of the partnership want to make sure that if you're one of those partners that your name is on the asset.
Right.
Or else you're just on the operating agreement, which that gives you no ownership of the asset. So
right. I mean, I'm sure it might hold some weight in the court of law. I don't know how it would all play out, but you really want to show, hey, you own more than just this piece of paper with your signature on it. The entity that you're involved with actually owns this asset. The assets deeded to that entity. So.
Yep. Good point. So with that's a partnership, right? That's a joint venture partnership, very, referred to kind of the same. And that's one way to do deals. It's a great way to get started. And then a lot of times in multifamily, you can structure the deal a few different ways. But oftentimes with larger deals, it's syndication. So when we're raising money from investors. So can you talk on that a little bit, kind of the flip side of, what a syndication is?
Yeah. So to compare and contrast the two, typically with a joint venture partnership type of deal, you have parties that all have an ownership, a fairly larger ownership stake in the company. It's not always fully well-defined, but everyone's kind of got a role in the business. On the flip side of this, if you're syndicating a deal, you'll typically have a general partner, so your GPs and your limited partners, so your investors versus your sponsors, and it's certainly a big difference, and there's a lot more rules that govern how you operate as a business in a syndication model versus a joint venture or a partnership model, right? So a couple things to peel back here, right? There's a lot of rules with whether somebody's accredited, sophisticated, or none of the above, right? So there's certain rules on how many of those investors you could bring into a deal. Typically, your LPs are going to be completely passive, whereas in a partnership or a joint venture type of deal, folks are going to have some type of role in the business. If you're taking on outside passive investors, typically that's what they're going to be. They're going to receive their whatever their return is, whether it be like a monthly, quarterly, annually dividend. But they're typically not going to do any work.
That's a good point of discernment to make right there, is that, partnerships, everybody is a partner. They're active. They have some kind of role in that partnership. That's why you usually see them as smaller, 2, 3, 4 people, combining forces, combining capital, and all bringing something to the deal. They all have ownership of the asset. And then in the syndication, what he was saying with GPs and LPs is kind of where your split, your roles are differing. So GPs are your general partners. You heard Andrew refer to them as the sponsor. So they're the person that operates the deal. They put it together. They secure financing. They manage the asset. They do everything. That's the GPs. Then you have the LPs, which is the limited partners, meaning they provide the capital, they put in the equity stake. They're your passive investors. So the difference between GPs and LPs, GPs run the deal, LPs invest in the deal. They have physical ownership of the asset, but they don't have any voting rights. They're truly passive, which is really the perk to this, and is why syndicators raise money, is, to get passive investors, people who don't want to have to do all the work that the GPs do, but still share in the ownership, and get equity in the deal, get cash flow, all those different kind of things.
Absolutely. And there's so many people out there, Blake, that want to get into real estate and don't know how. And this is always a good avenue for folks if they want to be passive and not necessarily deal with, the trouble of finding deals, the trouble of raising capital, the trouble of managing an asset itself. I always suggest people to, find good syndicators that could put deals together and make it work. And certainly an area that I'm pivoting to at the moment to try to raise more capital as I try to scale and grow my operations in a couple of the markets that I'm working in. So.
There is no better asset class for building wealth than real estate, and in most instances, people don't have the time or energy to invest in it on their own. So how do you build wealth with real estate when you lack the time and energy? Leave that to the GrowthView Properties. The GrowthView team finds, negotiates, and manages multifamily assets for private investors. Their mission is to help investors secure the ultimate asset, which is time, all the while impacting the greater good with their endowment fund that fuels the mission of charitable organizations. Find out more by going to thegrowthview.com. That's view with a VUE.com. Put your money to work so you don't have to at thegrowthview.com. Yeah, that's a good thing to get into next. And what me and you have talked about, in our weekly calls and stuff like that is, which one's the right path for you? What do you do first? And, there's people who go right to syndication and do, 100 unit deals, their first deal. Yeah. And then there's others that, buy a single family, their first deal. And there's others that, partner with some friends, buy a 4 unit, 8 unit, whatever. So what do you think is the right way to get started?
It's a fantastic question. And I love talking through this because I think there's no real right way to skin the cat necessarily when you're getting your feet wet in real estate. I always tell people, you just got to go do it. Right. Now my path, it wasn't always linear. There was a lot of balances left and right, but I always wanted to grow. So I certainly, I always condone trying to get your feet wet in something smaller first, right? Aim small, miss small, and go after a duplex, triplex, quad. Something that you can sink your teeth into, but really learn the ins and outs of the business, right? So the really good benefit of buying that fourplex was I managed it myself for the first couple of years that I owned it. And I was painting the walls. I was unclogging toilets.
As you're going, dude.
Yeah,
all the fun stuff.
You learn all about how do you fill out a lease? What's the right way to collect money? So you learn the basics of the business first, and then scaling and growing at that point becomes a little bit easier because you're able to call out the nonsense of property managers when they try to get one by you. Some of these bigger deals you can't manage yourself. How are you going to manage a 100-unit building by yourself if it's your first deal, right?
And then a lot of times with agency debt too, Freddie Mae, Fannie Mac, government-backed loans, they make you get a third
100%
property manager.
Yeah.
Especially if it's your first deal, that's like a requirement for those.
Oh yeah, 100%. Unless you have your own property management in place, which you probably wouldn't if this was your first deal, right? There's one caveat to all this, right? So I will say I've bought duplexes that have taken longer than and were harder to get closed than my 11 unit was. Don't let your mind limit you and to say, okay, I have to go buy a single family first or a duplex first. I always say that because it helps you progress and grow and organically get bigger. And it allows you to fight that elephant one bite at a time, right? But I would say, it was kind of eye-opening when I bought that 11 unit to say, okay, well, this was actually pretty easy I basically tripled my amount of doors at that point I had, and without much more work. So people don't think that sometimes. They're like, oh, 11 units is going to be 5.5 times harder than a duplex to buy, but it's absolutely not the case.
It's not, the work is not proportional with the number of units. And that's really the epiphany in, what the whole multifamily journey is about, right? That's me on my journey. That's you on your journey. And,
sure,
hundreds and thousands of people that have taken it before us and gotten there. So
absolutely.
Like what you're saying, that a duplex doesn't take much more work to close an 11 unit or close a 20 unit or whatever. And a 20 unit doesn't take much more effort to close than a 100 unit, and it goes just like that.
Yeah. Certainly there's a little bit more due diligence and a little bit more capital raising if it's a bigger deal and you need more money.
Yep.
You just build in some more time around each of those things. But for the most part, it's the process is fairly similar, and you surround yourself with the right team. It's not much harder or more labor intensive to do the bigger ones than it is the small ones. So
yeah, that's so true. And I figured that out while doing a 2-unit myself, like getting the commercial loan and going through this whole process. What Andrew was just saying, I was like, man, I could have done the same amount of effort and, closed on 10 times the amount of units, and it would have been
the other thing
a much bigger result
too. The bank for 1 to 4 units, the bank's got a lot more stringent requirements. Whereas with a commercial deal, a lot of times they're looking at the term they use. It's either like the global, they call it global something. I can't remember the exact term, but the global view of the property, right? Where they look at the deal and they take the deal into consideration more so than the people that are involved in the deal.
Yeah, they look in the commercial where they're looking at the asset.
Exactly. Is that asset going to perform?
Yeah, if the person checks the box, the assets, that's what they're looking at, because they're underwriting it based on the income it provides. So it's got to make sense. Basically, in commercial, you're buying a business, right? You're buying an income stream.
100%.
Yeah, it's an income stream. So that has to, there's got to be enough debt or enough income to cover the expenses and the debt, and then leave you some margin. And that's called the debt service coverage ratio, which is basically the margin that the bank wants to see that it's, got enough meat on the bone to service everything. So they get paid, and then, something happens.
That's the most important thing for the bank. They got to make sure they get theirs.
Yeah. So you said something pretty important in there that, you don't have to start with a single family, right? You don't have to start with a 20 unit. And I think it's important that, people start where you feel comfortable, right? Start where you feel comfortable, you can make the deal happen, but also push yourself just to get a little bit uncomfortable. Like if if you're 100% confident you can go close a single family house, like you look out your window and see that house, like I could close that, right? Then a duplex isn't much harder. So maybe push for a fourplex. If you can close a fourplex, like you've got enough money in the bank, or you've got a joint venture partner out there that you guys have enough money to get that, but maybe it'd be, one step further to go an 8-unit, right?
Yeah.
Push for that, but stay within your comfort level. And the same is, if you're, feeling confident about a 20-unit, like maybe you start with syndication that way and just go a little bit bigger because it's your comfort level, it's your education level. Like that's where you think you could be good at. But I definitely think you can't go wrong starting small, but also don't be afraid to just jump into it, right? Because you're going to learn along the process, and it's the law of the first deal. You get in, the next one's going to be that much easier, and then it's going to keep extrapolating from there.
It is all about action. I know everyone says that, like, oh, what's the biggest thing that separates the people that do and don't, right? It's action. But there's this Tony Robbins quote that always drives me. And it's whenever I have these limiting beliefs of why I can't do something, and he goes, it's not about resources, it's about resourcefulness, right? And what he means when he says that is, it's like, okay, there's certain resources that drive a deal, right? It's time, it's money, it might be capacity to get a loan. There's a lot of factors. Intelligence, right? Do you have the wisdom to be able to do it? So you as an individual, you don't need to have all of those components, right? You don't need to have the money. You don't need to have the time. You don't need to have the hustle or the knowledge, whatever the ingredients are to getting a deal done. If you're resourceful enough, you can pull people together.
And leverage those other ones. Yeah.
Exactly.
I've heard it called, right, the triangle, right? You got like your knowledge, your time, and then money. So you have to have those 3 things to get the deal, but you don't have to have all 3.
You got one, right?
Yeah, you got to have one, preferably 2, and then leverage out the other one. But you can leverage out the other pieces of that triangle and, find partners to fill in where you're weak, to make you stronger and to be able to do that deal. So that's an awesome point.
The other thing to think about too is, I always tell people is, you might think like, oh, I can never go out and raise $500,000 for a deal, right? But put a property on a contract, I bet you figure it out real quick, right?
It's easier than people think, right? Like they see a big price tag and say, oh, that's too much. But I've never got gotten a really good deal and people not be interested in it, right? Like
Correct.
the whole maxim, like find a good deal and you'll find the money. I think that's absolutely true. People might disagree, but find me a great deal, or find a great deal, Andrew. And I'm going to be like, hey man, can I jump in with you? Cause it's a good deal. Absolutely. Like everybody wants to participate in that good deal.
Absolutely.
Man. Another thing you mentioned too, and on the Tony Robbins quote, there's one I have right here in front of me. Do what others won't today so that you can do what others can't tomorrow. And that's the, fits into this conversation as well. Cause you have to go out there and do it, and make it happen. So I'm glad we hit that as well. Cause I look at that like every day. It's on my board right there. So
it's a good driver of why the things you do today. Right. Cause we talk about this a lot. There's a lot of people that'll just work their 9 to 5 and go home and watch Netflix, and that's fine if that's the life you want to live, and that's okay. But if you want that the extraordinary lifestyle, you got to go out and get it, and and there's no other way around it. So
yeah, exactly. I think those two quotes embody the journey so good, and that's why you do it, right? Is to get further along, like your goals in life, like your big vision, your big why, whatever drives you. Oftentimes you're not going to, achieve anything unless you put in the work and make the sacrifices, right? You have to be uncomfortable now. And I think that's what that quote is getting at. Like, do what others won't, like be uncomfortable now, put in the sacrifice, put in the work. And then when they're, still sacrificing and putting in work, like you're chilling at that point. You're sitting back. You've got it covered now. So
agreed.
Yeah, that's the whole thing. So reeling it back in a little bit to the syndication piece, you talked about there's some extra rules and regulations. And what he's talking about there is with syndication, you're essentially offering a security. So because you're having investors buy in and buy portions of this big multifamily asset, the SEC, the Securities Exchange Commission, views that as you're offering a security, no different than, Wall Street offering a Coca-Cola stock or Apple stock or whatever. So you have to buy by SEC rules. So can you speak on that a little bit? And I know you're not an SEC lawyer.
Yeah.
There's some different things that you have to be aware of when you're doing a syndication rather than a partnership.
Yeah. So I mentioned a couple things earlier, but I'll kind of call back on those. So first and foremost, typically with a private placement memorandum, which is a part of this process of raising capital for a syndication, you can typically only go after accredited or sophisticated investors. And so what defines an accredited investor, and I'm going to probably mess up the actual numbers, but it has to do with how much money an individual or them and their spouse make on an annual basis. I think as a family, it's like over $300,000, and as an individual, it's
$200,000 a year. Married is $300,000 a year, or $1 million of net worth, not the primary residence. So basically, high net worth individuals are people that make a lot of money. Yep. So think like your doctors, your lawyers, your uncle sitting back driving his Cadillac and throwing out money.
Yeah. Exactly. And the sophisticated piece, I think, is just a scaled down version of that, right? It's a lower dollar amount threshold, and the SEC defines how many of those each category investors you can bring into a deal. The other big piece too is you have to have a relationship with these folks, and it's a little bit loosely defined on what a relationship, prior relationship means, but typically you'll see syndicators want to reach out and have a conversation with you before getting to know you before they bring you into a deal. That they're not just crowdsourcing money, right, from a group of people.
Exactly. Like if Johnny's over here, I can't just call Johnny up and say, hey, I got this really good deal. Do you want to get in it? So it's got to be somebody that I have a relationship with already. And the SEC kind of leaves it as a gray area and doesn't define it because they give you some room to determine that. But there's a person that wrote a letter to the SEC. I'll have to put it in the show notes, but they wrote a letter and said what aspects of the substantive relationship
go into creating this so we can meet compliance.
Sure.
And that is why you see, if you look into real estate investments and then like a syndicator's website, you'll have a form to fill out, you fill out your suitability questionnaire, lets them know your net worth, stuff like that. They get to know you a little bit. And then the next step will usually be schedule a call, right? So then that's the creation of the relationship. They have the conversation. And from there, they'll collect your information. They'll start sending you, email stuff, you're getting caught up with them. And then usually at that point, maybe it's a second call, I don't know, but somewhere in there, like, you have enough evidence to say to the SEC, should they look into it? Yeah, I have a relationship with this person. And this all has to be done before like the offering is sent out for a specific property, right? So you can't get a property under contract and then start building those relationships to raise the capital. It has to be before that to meet the SEC guidelines.
So it's kind of an interesting point, though, because this gets to a conversation that we've had in the past, right? What comes first, the investor or the deal, right? Mm-hmm. And I think, as a syndicator, sometimes you want to pitch people an avatar project, right, as you call it, and say, hey, here are the type of deals that we invest in as a group, and talk a little bit about the people behind the deal. This way you've established that relationship with that individual. They might not soft commit any money off of an avatar, but they might say, okay, keep me in mind on deals. Now you could start targeting them. And a lot of this boils down to who you can and can advertise to, right? So, there's also a couple of different types of syndications as defined by the SEC. And one is where you can advertise to the masses, so to speak, so on social media or on TV if you wanted to. And the others are just spreading the word to people that you already have that pre-existing relationship with.
Yep. And what he's talking about there, guys, is the SEC has exceptions for real estate, what it means to like offer security. So they have the 506B and the 506C. And the 506B is the exception where you can use, your relationships. You can have unlimited accredited investors. And that's what Andrew was saying earlier. You're limited to 35 sophisticated. So these are people that don't have $1 million of net worth or make $200,000 single or $300,000 as a couple, but they have an investing experience. They maybe have some single family rentals or whatever. So they're sophisticated enough to make a determination about this investment. So that's what defines that. And then that's 506B. And then 506C is where you can advertise, right? So that's where you see, whether it's like Grant Cardone out there, talking every 5 seconds about this deal and that deal.
On every different social media platform.
On every platform, different posts. It's crazy what he does. Yeah. But that's a 506C. So he's able to advertise out his offerings because and that's all accredited. That can only be accredited. You can't go sophisticated. So those are the two little nuances. And then there's another one, I think it's called Regulation A, which is, or something like that, but it's not used as often because it's like twice as expensive to set up your compliance documents. But just a caveat, but those are your most common is 506B, accredited and sophisticated, can't advertise. 506C, you can advertise, only to accredited.
Bottom line, folks, if anybody's interested in getting into this, A, talk to somebody that's already doing it. B,
because we're not attorneys.
Talk to a securities exchange or real estate attorney that could help you, because they're going to have to help you draft up a lot of these documents, and there's a lot of varying prices that these can cost. It is a fairly larger expense than normal lawyer fees for like an LLC, let's say. So certainly you want to talk to an attorney and let them guide you. You also want to use an attorney too, and not just like steal some other person's.
Don't just download it off the internet.
Right. Because in the event that you do something wrong, you want, and this is advice I got somebody that works at the SEC, so you want to be able to point back to your attorney and have them answer the questions and say, okay, I advised him to do X, Y, and Z. You want to have that arm's length distance between you and you're advised on to a degree, right? So always consult with an attorney.
That's a really good point. We're definitely not SEC attorneys. We're just kind of giving an overview and our understanding of it to tell you the difference between a syndication and what plays into it, and then a partnership. And
correct.
And generally your partnerships are going to be much cheaper to set up, but you have limits to how many people you can bring in, and, limits your capital raising unless you have, a really rich partner or something like that. And syndication is where you can raise a lot of money, but you have to meet the SEC guidelines. So just knowing the difference in the two is important when you get started, and just making sure you're doing things right and aware of what you need to go dig into more and speak to your attorney about. So that's kind of the purpose of all this, so we can kind of equip you with what to do next.
Yeah. A couple other things I want to mention, Blake. So, and it's taken a lot of research over the years to figure out what the best mix of what you should get paid for as a general partner or sponsor a deal. And there's a lot of books on this too. And I've listened to a lot of podcasts just to educate myself on what the different fees are. So a lot of times a sponsor or a GP in a syndication deal gets paid up front with a acquisition fee. Okay. If you even rewind before that, the GP is doing a lot of the legwork up front, right? To raise capital, find deals, conduct due diligence. A lot of times they're putting their names as a on the note, right? They might be usually non-recourse loans, which is defined as a note that doesn't will go after the property if the payments stop being made instead of going to the individuals whose name are on the deal. So the property is securing the debt versus the individual. But some of these deals require you to sign on the dotted line as an individual to be as a soft sponsor or soft. I'm trying to think of the right word here, but whereas the individual is liable for the property. But anyway, so the GP does a lot of things up front and sometimes fronts their own money as earnest money that could go hard at some point.
Or due diligence costs. There's a lot that can go into it before you get it.
Correct.
Before the investment money comes in, right?
Yeah. A lot of people are like, oh, why did they get an acquisition fee? So that's typically the normal response. There's a lot of work that goes into it. Plus your time, right? What is your time worth?
Yeah. And for those investors too, it's important to that's not necessarily taken away from your return, because your return's calculated with that in there.
Correct.
Right? So it's not one of those hidden things that's deducting from, that 15% that's advertised or whatever. That's, the 15% is advertised with that already calculated in. So
correct. Yep. Yeah. So, good syndicators at least will be,
they should definitely, that should always be disclosed. If you're not being transparent, then you're probably in the wrong business for sure.
Yeah. So the other side of it is some GPs put their own money in the deal, some don't. And my philosophy is I don't like to invest in things that the sponsor, the GP, doesn't have skin in the game. That's just my personal opinion. There's people that argue that too, right? I'm doing all that work up front, and that's my skin in the game, right? And I just me personally, I feel that it doesn't matter if an individual needs to or has their own money in the deal, but I prefer to have my own money in the deal if I'm going to talk to investors about bringing their money in on something as well. So
yeah, that's a good point to if you invest with somebody, if they don't have their money in the deal, what else are they providing? It better be a lot of value equal to the capital, or, find out that they are, just another comfort level for sure.
And just as far as the other thing I struggled with at first is, okay, how much equity do you take as a GP versus the limited partners? And so far from my experience, typically the answer is it depends, right? But yeah. I always struggled with, okay, how much is this individual taking as an equity owner? And from everything I'm reading, it's 20 to 30% of the deal to the GP.
That's pretty standard where, we're in a partnership. You guys might all split it equal, whether it's two people and it's 50-50 or three people and you split it, each get a third of the deal. Usually in a syndication, the GP or the sponsor of the deal usually takes 20 to 30% of the equity, and the LPs, the investors, the passive investors get, 70% to 80%. So they get a bigger equity position.
Correct.
And then make sure that that split is somewhere in there, right? Don't be in a syndication where it's a 50-50 and the sponsor's taking all.
Yeah. You don't want the sponsor.
Sure.
I mean, as a sponsor too, like I don't want to take too much where people think I'm being greedy for the amount of work I'm doing.
Yeah, exactly. And that's all, goes back to being transparent up front.
Yeah.
So, Andrew, what steps are you taking? I know you said that your next step is, finding out how to raise more money and taking your experience in a bigger deal. So what kind of steps are you doing now, whether it's calling brokers or anything like that?
Yeah. This is certainly a tough one because I try to evaluate, and certainly we talk about on a weekly basis of like, okay, what are those goals that you're trying to achieve for the week? And what I recommend to a lot of people is to start taking, keeping track of what are your leading measures versus your lagging measures, right? So from a leading measure standpoint, what are the things you can do that are going to influence an outcome down the road, to influence your lagging indicators? So right now, I'm trying to focus on two areas of my business and expanding in two spots. So I'm doing deals in Chicago, whereas trying to find those good deals, which everybody knows good deals are really hard to find right now. So you either got to get really creative. Yeah, good deals are hard to find everywhere, right? So, so finding the good deals. So that's establishing relationships with brokers, casting a little bit of a net out on some of my internal marketing through ListSource and trying to find the right target properties on there and sending out reoccurring mailers or calls or whoever, talking with wholesalers. How many of those could you hit on a weekly basis? How many of those relationships can you build? Because you don't have any credibility in a market. The good deals are going to go to the people that brokers know can get the deal done. Right? Yep. So you're going to miss out on some of those opportunities. So that's on that end. The other aspect is finding deals and then raising capital. So I'm having a lot of conversations with folks that are interested in real estate, and they're trying to figure out the best place to place some cash. A lot of them maybe have exited the stock market on the way down, or got in on the way up, and now have a little bit some capital to throw around, or want to take out of the market because of its volatility and put in something more stable. Yep. So there's certainly a lot of interest that way. So those are the two areas I'm focusing on: capital raising and deal finding, and then. I think the only other pieces I've kind of concentrated. I'm spread out a number of different markets. I have some Airbnbs that were killed by the virus, right? Coronavirus. So we survived it though and got through that. But I think I'm going to start focusing on the Chicago market because it's my backyard and I'm very intimate with it as far as the knowledge of different neighborhoods. And I like the Southeast. I'm very bullish on the Southeast. So I'm getting into jacked.
I'm the same way, man. And I'm glad your Airbnb business got the vaccine and is cured of COVID now, and everything's starting to roll down there in Nashville. Mine is the same way. My short-term rentals here in Panama City definitely took the hit when COVID happened, but we rebounded pretty hard because I think people in Florida, they're just like, you know what? I don't care. There's beaches. It's warm. It's summer. Like we're going out. We're not wearing masks. So down here in Panama City, it seems like COVID's not even a thing, which is crazy. After we got through the toilet paper shortage, it was like full. But so I'm doing the same thing too. Deal flow and capital development. So those are the biggest things that are going to get you deals. You want to make sure it's like a funnel, right? You want to fill the top of your funnel with leads, filter them, offer on what's good, and eventually you're going to reach success at the bottom. So just filling the top of that funnel is my focus right now. Kind of like you're saying, fostering the relationships with brokers, and then also, finding the right investment partners, getting the word out there. Hey, this is what we're doing. Multifamily, right? It's a great time, right? The stock market, like you're saying, is everywhere, bouncing up and down. So helping
you just said something I want to comment on, but a few people have told me this now, but when it comes to raising capital as either a syndicator or whatever, you want to bring in partners for a deal, it's not the people that are the best. It's the people that are the best known that get the most capital, right? So we talk about this a lot, right? So that's the other piece of the equation of capital raising is I got to start beefing up my social media campaigns and getting my name out there more.
Man, get that handsome mug out there.
Yeah.
I know you're buying real estate.
you know it.
Yeah. So we're getting towards the end here. So we'll transition to the last segment of the show, which is the common questions at the end. So we'll just jump right in and kick it off. So, what's been your biggest mistake so far that's turned into a learning lesson for you?
So a couple things here, but biggest mistake, I think, would have to be, I bought a condo in El Paso as my first deal, right? I don't think the concept of it as a mistake, was realized at first, but I bought a condo in a market that condos weren't, popular in, right?
Mm-hmm.
So, condos
was that
are
just
kind
because it was cheaper, or?
Yeah. So I think I was living in an apartment at first, and I said, okay, what's the next best, like, closest thing to what I'm comfortable with at the moment, and is cheap. And, so I went with a condo, and I was 22, right? So a lot of decisions I made back then were kind of questionable, but they always say that like unique doesn't really sell that much, right? Or doesn't sell well. There's only like 2 condo complexes in all of El Paso. And some might say like, oh, that means, if there's demand for it, there's no supply, right? But no, there's no demand for, or not much demand for condos.
Yeah, so real estate, you don't necessarily want to stick out, right? Yeah. You want to be just like what's selling across the street or down the road, because that's like your perfect comp.
So while it's never hurt me, I still own the deal to this day. It doesn't make me any money. It is kind of like a dead weight on my portfolio. So that combined with the story I told before of not doing the full due diligence. I have a check sheet that I go down that's like, I don't know, 40, 50 items deep. That's not just a checklist, but it's a step-by-step kind of guide to follow whenever we're getting into a new deal. So I use that to my advantage. So those are my 2 things. Don't buy weird, unique stuff, and do your due diligence.
There you go. I like that. But in retrospect, at the same time, like it led you, you took action, which is good, and it got the ball rolling. So not all waste. Now you just need to
correct all lessons. Yeah, all lessons you take with you on your next deal as you get smarter in that, right? Nobody's perfect. Everyone's going to mess up at some point. So
I love it. Just keep on keeping on. Okay.
Exactly.
So what is a resource you'd recommend to someone, whether to somebody starting out, whether it's a book, a website, blog, anything like that?
So a couple things. One, there is a plethora of information online right now. So if you're just getting started, going to Bigger Pockets would be my best bet, right? I listen to like 10 podcasts a week between a bunch of different ones. So Bigger Pockets be one. Joe Fairless has a lot of good multifamily resources. He does a daily podcast. This podcast obviously is going to be an instant shameless plug. Yeah. So I always suggest people get educated, not to the point where they get analysis paralysis and don't take action, but going out. Bigger Pockets has a ton of resources. I would start there, and then there's a ton of books as well that have changed my way of thinking on real estate investing.
What's one of them?
So I don't want to give the standard Rich Dad Poor Dad, although I did read that in college, and it transformed the way I think money.
Right at a good time.
Everybody says that. It's a paradigm shift on.
Yeah, if you haven't read that book, literally stop this podcast, pause it, and go read Rich Dad Poor Dad. Yeah. Literally get on Amazon on your smartphone that's like within arm's reach of you right now and order Rich Dad Poor Dad. But yeah, those are all good suggestions. Bigger Pockets that's where I got started as well. Just reading their books, reading the forums, like just soaking up information. If you like go look at my account, you probably will see a lot of stupid questions early on, but now I'm like trying to give back like the lessons I've learned too.
You could save a lot of time by learning from other people's mistakes.
Oh yeah, certainly. Absolutely. I've avoided so much And me and you talk about this too, right? Like when you started, Bigger Pockets wasn't out there, and all these different educational sources weren't around. So you kind of just, I want to say stumbled through it, but had like a steeper learning curve. And now there's so much out there, right? Like you don't have to make all the mistakes up front. Like, yes, you're going to fail at some things and you're going to learn, but man, you can really flatten that learning curve and start from a much higher level if you just, you go out there and put a little bit of diligence up front and
for sure.
Just get to 70%, get to a 70% solution, just go like,
then go out and do it. Yeah.
Everything else we learn along the way.
100% agree.
Yep. So what do you like to do outside of real estate? I know you got some other hobbies.
So, I like to travel. That's one of my big ones, although that's been kind of hampered over the last 6 months or so. I am back to traveling for work though, which I don't necessarily love that type of travel, the Monday through Thursday grind. Mm-hmm. I certainly like going. So my wife and I, before kids, love spending time in Europe. I love old houses. It's one of my favorite things. So we go to a lot of open houses, in our neighborhood has a lot of historic houses, so I like to go look at those. So those are probably my two favorite pastimes now, aside from just real estate in general.
So that's just your hobby. I was like, your non-real estate hobby was still real estate related.
Yeah, I know.
At least I had the family in there.
My friends used to always make fun of me, like, you don't have any hobbies, like you just like money and real estate. Like, yeah.
No, my wife says the same thing. She's like, you don't do anything but work.
I like to read though. I'm a big reader. I've gotten back into exercise again, so I do that a lot now.
There you go.
And just to try to get my health back in shape now that I'm not running every day with the Army, So, but yeah, certainly reading and travel would be my top two.
Good deal. Love it. So, Andrew, this podcast was awesome. Where can people find out more about you or connect with you?
I am on Facebook and LinkedIn. People could certainly find me there, or we could post my phone number and email in the show notes if you'd like, and certainly people could get in touch with me whenever they'd like. But again, I know I have to get more active on my social media side, but it's easy. Andrew Dorazio, pretty easy to find me on both LinkedIn and
awesome.
Facebook.
Well, man, this was awesome. I think you're gonna get a text message from all 2 listeners right now, so you'll have a lot of time on the phone. But man, I appreciate you coming on here. This was an awesome show. Learned more about you that I didn't know before, so that's always good, and just provided awesome value. How to start out with partnerships and syndication and the difference between those two. Awesome discussion and super important for those starting out. So thanks for providing that for the listeners, and just appreciate you being here, man.
Of course. Thank you. Keep killing it, dude. I love to see you keep growing like this. And I hope people one day when this is a hit will come back and watch episode 1 and be like, oh, this guy's all right too.
Yeah. And now he's got, a bunch of properties. It'll be good. It'll be a good retrospect.
I'll come back at episode 100.
But all right, man, out of here.
Hey, take care. Have a good weekend.
Thanks. You too.
Hey, thanks for listening. If you like the show, if you found value in it, please go to iTunes and leave a rating and review. If you want to check out more on your multifamily journey, go to multifamilyjourney.com, where you can get free resources to start your journey and figure out your path. That's multifamilyjourney.com. But more importantly, go take action today towards your financial future. See you next time.